Welcome back to the channel, everybody, to another great week, and we are continuing with our series on option strategies this week, and we're going to continue with our cash secured put that we talked about last week, as well as covered calls we've covered in the past. We're going to combine these two to create what's called the wheel strategy of options trading. It's a great way to utilize your current stock investments and in order to create some more passive income by using the writing or selling of options. So if that's something you're interested in, this is the place for you. Hope you enjoy this video, can learn something and take it away into your investments. So thank you for watching, and I'll see you all next week. Welcome back, everybody, and this week we are taking a look at the option wheel strategy. In the past, we've been learning about covered calls, and we've done a video on this if you want to check it out, as well as the cash secured puts just last week. So now we can actually utilize both of these strategies into a single income producing strategy, and that in itself is the wheel strategy. So in one sentence, what is it? The wheel strategy utilizes the selling of options on various equities of your choice on which you are long-term bullish in terms of outlook to generate a continuous passive income over time. Now technically we can opt to start anywhere along the cycle, but in this case it makes the most sense to initiate the entire process with a cash secured put, since we don't yet own 100 shares, and if you do, we should start with a covered call. So how does it work exactly? Well, to discuss this, let's start with the first leg of the wheel, and that is the cash secured put. Imagine you have found a stock or an index for which you want to own or purchase 100 shares, but the price isn't quite enough to buy yet, quite low enough to buy yet. You aren't intrigued enough. So what you can do is you can sell or write a put option with the aim to purchase the stock below the current market price. In order to do this, we need to sell an out-of-the-money put option and collect a premium. That means the strike price is below the current market price. Until the stock price falls below the put strike price, meaning that we get assigned in this case since we are short the option, we can actually keep rolling the put option and collect more premium as it matures. When the assignment of the put option does occur, the buyer of the put has the option to sell 100 shares as per the contractual obligation, and if and when they do this below the strike price, you are obligated to buy the shares from them. In this case, for one option, it's 100 shares. Once we then own the shares, we've collected the put option premium that we've got up front, and the contract is fully closed, and we own 100 shares of the stock at a good price, and then can proceed to sell a covered call on our newly obtained shares. This is where the next cycle of the full wheel strategy starts. Unlike selling the put, however, when we sell a covered call, we want to sell it above the current market price, and the strike is still out of the money for the call option since it's the opposite of a put option. And again, we collect that option premium up front. Similarly to the cash secured put, we can keep rolling the sold call contract until the buyer of the call exercises their right to buy above the strike price that we've chosen. So when this happens, we sell our shares to the call holder, take our profit from the share appreciation as well as the premium up front, and we then have no shares and no option contracts outstanding anymore. At this point, we are back where we started, and we can repeat the cycle and try to obtain the shares once again through the cash secured put. Now essentially we can continue doing this until we can do this cycle indefinitely and make it passive income while doing this, which is the beauty of it. So let's take a look at an example to make it a little bit more clear what's going on. So at Investonomics, we like the idea of the price stability of index ETFs and utilizing the associated index options for the wheel strategy. And the index options are the options on that index ETF. Currently, the SPY or S&P 500 index fund trades at around $370 per share, And let's say that we would want to own 100 shares, but only if the cost basis or our purchase price is below $360. So to do this, we can simply write a July 29th put contract for 1 month out and collect the full $900 option premium up front. We then wait for July 29th unless we are assigned, and this is a good thing if not too much premium is lost due to too much time value remaining. If assigned, we own 100 shares and partial premium, and if we're not assigned by July 29th, we keep the $900 and just write another put option, rolling that selling option over. So we need to be sure we have sufficient capital to purchase 100 shares when writing puts. In this case, we need $36,000 or the 360 strike times 100 shares in case we get assigned. Once we've acquired the 100 share lot through assignment, we purchase at $360. But the $900 premium effectively reduces the cost basis to only $351. Since we make $900 divided by 100 shares, that ends up being $9 a share. We can then aim to sell the shares at an original market price or higher at $370. This is the out of the money strike price for which we write the call contract for the covered call. And by doing this, we collect a premium as well as profit through share price appreciation. So in this case, that's 370 minus 351 times 100, which is $1,900 in profit. And once we sell the call option, we receive $1,000 in premium for the 1 month option, effectively reducing the cost basis to just $341 a share. So you can see how this keeps happening to reduce the cost. We can then keep rolling the call option much like the put option before and collecting premium if the strike price is not exceeded. In these cases, the option expires worthless and we keep that premium. But if it is exercised, we get the strike price for all 100 shares and that appreciation up to the strike price, meaning the total profit from one cycle, including the premiums, ends up being $2,900. And once the shares are sold to the buyer of the call option, we are back at stage 1 and we can sell another cash secured put, and we can do the cycle all over again. There are also some caveats we need to keep in mind here. One of the biggest concerns with the wheel strategy is this, and that is, where is the risk? If we make a decent passive income, there has to be some risk attached, right? Because we don't make a risk-free return. That doesn't exist in the world. We need to have some form of risk. But there is risk involved here, but it can be generally avoided through different mechanisms. The main area where risk actually arises is the volatile and unreliable nature of various stocks and ETFs, and this imposes risk of the company's default, where the stock actually goes to zero. Now, the second risk is the inability to establish and get out of various option positions due to the option illiquidity for a particular stock. This is especially true for various different strike prices. So we therefore recommend using a stock index and index options for the wheel strategy. And indices represent many companies in this way. And if one of them fails, the index may lose some value, but it won't go to zero. Indices historically also consist of much higher stock and option volume than single name stocks. Liquidity is very important for the wheel strategy in order for it to work well, both in terms of option volume as well as the actual equity volume. The better known and the bigger the index, the better for this strategy. In order to utilize the high liquidity, we recommend indices such as SPY, TQQQ, JETS, and USO, but large blue chip companies typically also perform well in this aspect. Now, the second area for risk that we've discussed is when the stock or index continues to decline when we own 100 shares and we are selling covered calls on them. So as an example, we hold currently American Airlines, 100 shares of it, on which we are selling covered calls for 7 months, and that's ongoing. Premiums help us make up the losses, but we need the market price to exceed our strike price, which is above our purchase price, in order to make back the original investment amount. As the stock or index falls, the original strike price will become further out of the money, which means we make less premium if the strike price is not altered when rolling the option. So if we don't lower the strike price, it's going to keep becoming less that we're earning in terms of premiums. So it's very important to determine whether to reduce the strike price below your current cost basis, or rather to collect less premium until the price comes back up in these scenarios. So this emphasizes the need for reliable equities on which to trade the wheel strategy, and we need to choose very wisely. In terms of the maximum loss that we can occur on this ends up being the strike price minus 0, which is the default of a stock minus the premium that we're earning times the 100 shares. And that is our total maximum loss. And this is only for the covered call portion of the wheel strategy. For a cash secured put, we don't own the shares, and so we do not have a maximum loss, and it's limited to the premium. So it's worth noting that both calls and puts are sold out of the money, representing the direction we expect the price to move. So for puts it's down, calls it's up. So just some final comments here. The wheel strategy is very powerful if used correctly, and it allows a dynamic approach to options trading, and it allows passive income to be collected at every stage of the cycle. And again, it's a cycle, so this can keep being repeated over and over. It is pertinent, however, to choose a highly reliable stock or index with good volume in order to efficiently utilize this strategy. So thank you all for watching, and I will see you all next week.